Very important comments coming there. Apart from the policy, the big headline coming in is that the liquidity coverage ratio, or the LCR norms that were to kick in from the 1st of April will not be kicking in anytime soon. In fact, not until 31st March 2026. So FY27 is the earliest that we may have the revised LCR norms kicking in, which had proposed an additional 5% liquidity buffers to be maintained by banks to consider for the runoff effect because of the digital nature of banking in these days' time. So that is a huge relief coming in for financial entities, for banks. Apart from that, the governor also making it very clear that the expected credit loss guidelines, the draft for which is yet to come out, and the project financing norms, which again had proposed higher provisioning for infrastructure projects. The two are aligned, and again, FY27 is the earliest that the RBI may even look at that. But for now, the big overhang of LCR guidelines kicking in from the 1st of April, that completely goes away. So that is one of the big takeaways coming out of this press conference. The RBI governor making it very clear that they will give banks and financial entities ample time to transition when it comes to these big guidelines and big revisions in the framework. Apart from this, the very last answer again, making it clear that there's no rethink on the higher risk weights that were assigned for unsecured loans, whether that was for bank lending to NBFCs or for unsecured loans themselves. So no change there. Two big headlines coming in there. With that, let me invite our guests who are with us. Mr. Dinesh Khara, former chairman of State Bank of India. We also have Pranjul Bhandari, chief economist at HSBC, and Ashhish Vaidya, the managing director and head of Treasury and markets at DBS Bank India. Thank you very much to all of our guests for joining it. Mr. Dinesh Khara, first reaction from you on the LCR guidelines being deferred. How much of a relief is that, at least another year given to banks?
I think it's a very welcome move, which has been announced by RBI governor, and particularly, when it comes to LCR will actually warrant banks to invest into certain defined securities. So I think this kind of a headroom which has been given to not to implement it before 31st of March 26 will also give enough elbow room to banks to really ensure that they can orient their Treasury investment policies accordingly, so that there should not be a shock at all. I think it's a very welcome move, and also in the current kind of a situation where the liquidity was at a system level, liquidity was a bit of a concern. So I think it will ensure that there is enough liquidity in the system, which will help in supporting the growth initiatives of the economy.
Mr. Khara, did you get the sense that there may be a rethink on this increased provision requirement itself, apart from deferring the deadline by another year? What was your reading of what the governor and the deputy governor said on LCR?
I think they have very clearly mentioned that they have invited the responses from the regulators, and they are actually evaluating all those responses. So I expect that it is going to be some kind of an inclusive policy, which will keep in mind the responses of the regulated entities, and if at all it helps in achieving what the RBI is looking for in terms of achieving through implementing this LCR, if at all that can be achieved through some other means also, I think they are quite open for that. So this is very welcome, I would say, from the regulated entities standpoint. But yes, of course, they are having in mind the kind of changing realities, and also with the kind of digital coming into play and how the money can move in no time. So I think that's something which is the guiding factor when they had thought in terms of implementing LCR. So they will try to strike a balance between what is required for this kind of paradigm change which has happened over the years, and what ensure the stability of the system.
Mr. Khara, quickly before I move on to some of the other topics, the project financing guidelines, we of course know there's been a lot of pushback from the banks on this additional provisioning requirements for infrastructure projects. The indication again from the governor seems to be that they will be released along with the expected credit loss guidelines, where the draft has also not been formed yet. So you think that is out of the picture until ECL guidelines are drafted and consulted upon? Project finance, the additional requirements will no longer be, put on banks at least until FY27.
Yeah, because there are overlaps as it is between the provisioning which is done through the ECR and also ECL, and also with the project financing additional provisions which are required to be done. So I think they are trying to really ensure that there should not be any overlap and there should not be any excess of the provisioning which should be there, because eventually, all said and done, all these kind of provisions will have an impact on the credit cost and will eventually show up in terms of the cost of lending also for the banking system. So I think it's again, I think it's a very, very pragmatic step which has been taken, and I'm sure it will go a long way in terms of supporting the project finance initiative and the growth initiative.
Well, Pranjul, thank you all for standing by. Pranjul, what were your key takeaways, from the policy announcement? Were you at all disappointed to not hear more on liquidity? What did you make of the comments?
Yeah, I think, what stood out for me in the press conference was when he spoke about marks, do we attempt to get just pass marks or full marks? And I think in that context, I would actually give full marks to this governor, because at the end of the day, he's been able to tread this very fine line of bringing about more flexibility in existing frameworks in order to give you better growth outcomes, but not really junking all of these frameworks, working within the very frameworks. And I think that was really the masterstroke. If you look at what's happening with monetary policy, he spoke about working on the flexibility embedded within the policy. So you don't really have to get to 4% inflation before you start cutting rates. But as long as your models show you that you're in the right track and you're getting to 4%, which his forecast did show eventually, you can start cutting rates already. So that flexibility, I think, will give very positive growth outcomes. And I think the similar thing we've seen for the regulatory front as well, right? He's not junking all the LCR and all of these norms that they were talking about, but he's trying to postpone them a little bit and also staggering their implementation, giving the markets better time to basically come to terms with all the big changes that are going to happen. So I would say on the whole, very positive. This is very important, because if at this point of time he had given a signal that he is not going to stick to previous old frameworks, then I would have said that people would start putting questions to the macro stability of his actions. But I think he's given us the best outcome.
All right. Ashhish Vaidya, you think this is the best outcome we could have got, deferring the LCR guidelines, saying that they will be, proactive when it comes to liquidity, giving some, as what we're hearing, more realistic sort of projections as far as growth is concerned at 6.7%, and delivering that 25 basis point rate cut that the markets had asked for. Ashhish?
Yeah, I quite agree. Actually, this is probably the best possible outcome which the governor has actually delivered. It's really not important to look at today's market moves, because that will be actually driven by more of opportunistic position by traders. But I think a lot of decisiveness which the governor has already displayed before in the last 1 month while he took the liquidity measures, and the way he has gone about explaining as to what kind of forward-looking thinking and the nimbleness with which he is looking to operate within the parameters that have been defined for the RBI, I think is an excellent outcome. So I think we are really looking at it positively, and it will actually bring in a lot of stability and continuity in the market.
Okay, Mr. Soumya Kanti Ghosh, what was very interesting is the governor alluding to the flexibility provided by the inflation targeting framework, not repeating what we've been hearing through the year about getting to that 4% CPI mark before the Reserve Bank of India can act. So the RBI is going to be forward-looking. What do you make of his comments, and what we can expect, going forward from here in terms of further rate cuts?
Thank you, Ritu. I think there are a couple of paragraphs in the policy that are very well communicated to the market. I think this is the paragraph on inflation targeting which you are talking about. And I think this is basically a excellently and well-crafted communicative statement to the market, and it puts to rest about the market cacophony or the cacophony about not sticking to the current inflation targeting regime, tweaking it or otherwise, because it gives a sense to the market that the stability and continuity in macro policy, which has been the hallmark of the monetary policy in the last 3 to 4 years, remains in force. And that's why repeatedly you will see that in the press conference, the governor also pointed out his financial stability has an overarching aspect of this monetary policy. And that is possibly the reason why all these regulatory measures are now kept in abeyance, or they will be implemented as and when the time comes. So from that point of view, it's a sense of continuity, stability to the and flexibility to the policy, operating policy framework. And I think that a statement on inflation targeting, even on exchange rate, if you actually go through the footnote on the exchange rate, you will find that the 3.2% depreciation on exchange rate, which the governor talks about since the American election, that is almost synonymous with a 2.4% dollar appreciation. So what he's trying to say that the recent disturbance in the exchange rate is more a reflection of the market forces and the global uncertainty. So from that point of view, I think the policy is more about well communication and also importantly more about footnotes, which you need to go in detail to get into the nitty-gritty. And regarding the future trajectory that you have seen with inflation at 3.8% next year, growth at 6.7%, I think that opens up further space for rate cuts. And if the inflation continues to surprise on the downside, this month's inflation number could actually be a significant downside as the vegetable prices have corrected significantly. We can see more rate cuts in the offing, and that could be more than the consensus if the global geopolitical uncertainty stabilizes a bit in the next couple of months.
And what is that consensus, Mr. Soumya Kanti Ghosh? We've been getting differing views ranging from 50 basis point rate cuts to 75 to 100 basis point rate cuts in this cycle. What is your view?
No, I think if the global geopolitical uncertainty stabilizes, I think 50 basis point rate cuts, which was mostly the consensus across the market domain, I think that could become an outlier in the coming days if we go by the inflation forecast.
Okay, and Pranjul, what is your base case in this cycle, given the 2% kind of an inflation outlook for the coming year?
Yeah, so look, we are expecting another 25 basis points rate cut in the April meeting, so making this a 50 basis points rate cutting cycle. And to the extent liquidity is sufficient, I think that on itself will also give us 25 basis points rate cut. So effectively a 75 basis point rate cut, if you also include what happens via liquidity. We don't think it's going to be more than this because at the end of the day, you really have to also look at global volatility. And I think our BOP and balance of payments, current account don't really support a very deep rate cutting cycle at this point of time. I also think there's going to be more liquidity measures that will be announced, in fact, as early as end April. So basically 2 weeks from now, because my sense is otherwise in March, liquidity will go back into, a substantial deficit. So my sense is that, more liquidity steps will also be announced. They won't announce today, but that doesn't mean they won't be announced because the promise of sufficient liquidity is there. And finally, many of the things and frameworks that are going into review, I think will be very interesting. I think the economic framework will be extremely interesting because over time, it will also tell us about how much dividends can the government get from the RBI.
Okay. Thank you very much. I just wanted to ask Ashhish. Ashhish, what did you understand about the liquidity? Did it give an impression that where they see a deficit they will give? Or did you get a feeling that hence, because he said that we are looking at liquidity not just interbank but also durable, including the government's liquidity, or what is it, the government? Is it giving a sense that henceforth largely banks will be lending in SDF rather than borrowing? They will ensure that much surplus?
So Lata, good question. So let me give you my take as to what exactly I have understood. Clearly, I think he's drawn a distinction between durable liquidity and the transient liquidity. And that's actually very important. And if you look at his actions in the past, like last 1 month, I think RBI has come out very decisively in terms of giving liquidity to the market. I think broadly what he is really committing, and I think people will have to start to take him at real value. And that's where people will find clarity emerging as they go ahead. Not to look for immediate liquidity actions just because there's a policy or something. I think the way the RBI is conducted, very decisively, despite rupee weakening, the liquidity measures, both in terms of OMO, swap windows, I think that's great. I think markets, to my mind, should factor in about 60-70% of durable liquidity and about 30-40% of transient liquidity. Eventually, I would think that the liquidity will move towards a surplus, like the other panel members are saying, and which I completely agree. You probably get a rate cut next, and with probably a stance shift, and that really tilts the liquidity into a positive territory. So that's what broadly my understanding is. I think the governor and the RBI is completely in control and decisive in terms of how they're going to manage the liquidity.
Okay, fair enough. May I ask, therefore, Mr. Khara, so you think, therefore, that the rate cuts will get passed on? And secondly, he made a lot of reference to asking banks to lend in the interbank call market. The statement said that, you know, we are not restricting any such lending, because interbank call has hardly 15,000 crores. Sometimes the volume is very low, whereas in the tripartite repo it is in lakh crores. So is he removing any trepidation banks may have, borrow from repo and lend in call? He's removing that trepidation. Do you feel that way, that it was positive? So two questions. Do you think it will get passed on quickly? And will there be more flow in the money markets?
I think the intention of banks to participate more and more into the interbank call money market is essentially from that point of view that more and more flows should happen. And when it comes to the trap market and the call market, there is whatever differences are there in these two markets, they would get evened out. That is what the intention seems to be. And your second question relating to, you know, the passing down the interest rate benefit reduction in repo. Repo, of course, is something which is one of the determinant, because when it comes to external benchmark linked interest, there, of course, it will get passed on. But if at all external benchmark was essentially linked to repo, then only it will get passed on immediately. Otherwise, if at all it is linked to MCLR, etc., then...
Mr. Khara?
Yeah, sorry.
No, Mr. Khara, he is also promising liquidity. And therefore, my question is a little medium term. Do you therefore expect that this craze for deposits, the banking competition for deposits will slow down a bit, because Reserve Bank is committing to giving more liquidity? And therefore, it's not like in 1 month, in a couple of months, deposit rates will start falling?
See, actually, when you look at the banking business, they look at RBI as not at the first port of call when it comes to the deposit or the liquidity. They actually look at the bank RBI as perhaps the last port of call for augmenting their liquidity. They need to have the deposit base. Unless and until they have a stable deposit base, they cannot really plan out their loan strategies, etc., etc. So I think when it comes to deposit, eventually, the interest rate on the deposit will eventually be the function of the overall liquidity, which is stable liquidity in the system. It will not be the transient liquidity, as it has been mentioned. So durable liquidity only will influence the interest rate. That is what my take is.
Okay. No, the reason why I'm asking you is, a lot of bankers in our Ritu's and mine preparation to the monetary policy, bankers were saying that, you know, if they tell us, give us some comfort that, okay, now we are happy with the credit deposit ratio, then we can start chasing credit. If they give us some comfort that liquidity will be there and that we are not constantly going to them to borrow, then we will have greater confidence in cutting deposit rates. This is what bankers told us in the run-up to the monetary policy, and he seems to have given both. They seem to give confidence that, okay, now the credit deposit ratio is fine. And they seem to give confidence that we will proactively give liquidity. That was the word they used. So I'm asking, will credit growth improve?
I think credit growth will improve depending upon the opportunities which are available for lending in the market. And lending in the economy, if at all there is an overall economic growth, there would be certainly, banks would be happy to lend and also generate income. That is what I would say that all bankers will think like.
Ritu?
Well, you know, there's one more thing I wanted to highlight, Mr. Khara, was, you know, the very last question on the higher risk weights on unsecured loans. Clearly, the indication is, yes, the RBI is satisfied with the pace of, you know, growth in unsecured segment coming down drastically from 2 years ago. But it doesn't look like there is a rethink on, you know, reverting back to the risk weights that were before they were increased. Mr. Khara, is that the expectation, these higher risk weights, especially for bank lending to NBFCs, are to continue, so there's no relief on that front.
No, I think considering the fact that the kind of delinquencies which are seen in the unsecured portfolio of the various banks, but I don't expect that there would be any kind of a relaxation when it comes to the RWA for the unsecured loans.
Very much the messaging from the Reserve Bank of India as well. Quickly, Lata, you had another question to add.
Well, not question as much as a takeaway which we got, because the governor also spoke to us off the press conference, off the auditorium. So before we wind up, I just wanted to say that the first or the second paragraph, I think, where he speaks about flexible inflation targeting, I think that was an important point he made. The question was, why are you taking it up at all? There were statements, if you remember, in the previous economic survey, where the request was that food should be excluded from the target. So it appears that that statement was there to commend the flexible inflation targeting, to say it has worked well, because it's about 10 years, 9 years to be precise, and they wanted to praise the flexible inflation targeting framework. So I think that's very important. The framework is not in question. That was a key takeaway we got off the auditorium when the question was asked to him, why did you raise it at all? And he said, I raised it to commend what is a framework that has worked very well through COVID and through turbulent times. I thought that that's an additional information that was needed. Thank you very much, Mr. Khara, Pranjul, Ashhish, and Soumya for being with us. Thank you, Ritu, as well, for going through this monetary policy framework, monetary policy analysis. It looks like it's an extremely well-balanced policy, giving inflation coming down its due share and at the same time retaining most of the caution that is merited because of the uncertain global environment. Thank you very much for watching our Monetary Policy Special.